Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. I hope you've been enjoying all of the content from this year's VRIC. We have 100 videos plus posted on the channel. Be sure to check all of those out. But of course, we are bringing the VRIC to you with our series of expert online panels. And I'm very excited for the one we have lined up for you today. We have William Rhind of Granite Shares and Frank Holmes of US Global Investors and Hive Digital Media. Gentlemen, it's an honor to have you both on the show.
Thank you, Jesse. Thank you for having
Great to
us.
be back.
Yeah, I've interviewed both of you one-on-one, so I thought it'd be great to bring you both back as a team. And the thing I want to start with is both on this program and on my own program I host as well, I've noticed the main theme right now in the market seems to be uncertainty. I speak to a variety of different experts such as yourselves, and I get such a different variety of answers on an outlook for the broad market, the US economy, the global economy. So I'd love to get your thoughts. William, I'll start with you on this one because I know your company also does leverage single stock ETFs featuring some of the companies in the Magnificent Seven. So are you bullish on the broad market at this point?
Yes, in short, and I think that I've been saying this for some time now, that the economic data seems to be, or continues to be, robust, and despite clearly some signs of uncertainty around certainly the tightening of financial conditions and some of the stresses we're seeing in the housing market, amongst others, that the market's at an all-time high, that we're still pretty close to full employment. And I think the important thing from my perspective is always, it's difficult to see, where this catalyst might come from that would sort of derail things in the very short term. So I continue to be positive on the market, the US market, that is. I know it's not an equal or an equally shared picture with global markets by any means. But for the US market, I think I continue to be positive and think that is reflected, and we'll probably talk about it a little bit as we go in, but broadening out of the market from not just the Magnificent Seven stocks, not just the largest tech stocks, but into some of the other sectors as well.
And Frank, your thoughts currently on the broad market, the fact that it does seem to be being held up by this small handful of tech stocks?
Well, I think that I agree a lot with the comments by Will, and I think we have to take a look at a bigger picture to sort of overlay where his comments are, and that is the presidential election cycle. A year ago, I said based on 80 years of data points, whenever you have a Democratic president and you have basically a Republican Congress, you get a double-digit return in the S&P 500. And everyone was so negative because rates were starting to rise, and we still have this long extended inverted yield curve. And most of the pundits are on television, the normal sort of media streams, they're all want to talk something negative. But what they forget was that, as Mark Skousen recently said, last week I was in California speaking at Investment U on the Oxford Club. And it was interesting because he said a lot of it comes from Trump's tax cuts. Corporate tax cuts have had a significant impact on corporate activity in America, which I never looked at. But what I did look at is what's happening in Ukraine, that war. America's basically given a lot of its old military equipment, and there's a revitalization of the latest technology. And when you look at the military industrial complex in America, it's in every state. And so you are able to have a real political feel. Both Democrats and Republicans throughout the country are all about rearming the military. So that's a pretty steady spend, even with inverted yield curve, and even with the cost of cars going up and this other inflation. There's this continuous spend going on in the economy of high-paying jobs. So I think that's something we have to really appreciate. And when we look now going into the fourth year of our presidential election cycle, odds favor for us a return of 7 or 8%, but that's usually rates are rising. And this year it looks like rates are going to be falling in the second half. And that is pretty bullish.
So, would you say the American economy in general looks strong right now? I've spoken to Doomberg, and one of the points he made about the current strength of the US economy is cheap energy, an abundance of cheap energy, shale oil production, as well as very low natural gas prices at the moment in the US, are a real driver for industry and for a strong economy. I'm wondering if you would agree with that, and if there's any other indicators. You mentioned the negative headlines. We see them all the time, that sells clicks, those types of headlines. Are people paying too much attention to that and not really looking at the fundamentals that lie beneath them? And Frank, I'll start with you on this one.
Yeah, I would say that most people are listening to a negative narrative and not betting on this sort of incredible economy. I think it's pretty stressful where I'm in San Antonio, Texas, on the natural gas frackers because gas prices are so low for them to go and continue to drill. But it is an incredible dynamic for exporting LNG. And with that, I think from the shipping lanes, that's been an important sort of export that America's been contributing to the global economy. But America has so many other aspects to it, and I really, one of the big parts of with Hive is in the space of technology with data centers. We've seen a huge boom in the growth of our HPC from in the past year because of the Chat GPT and the amount of capital going into venture capital and AI. And a lot of businesses are trying to use AI to streamline their cost structures. So I think that it's been estimated in the next 6 years could add to $17 trillion to the global economy.
And William, your thoughts on the strength or lack thereof, if you see any weakness in the US economy?
Well, to echo, I think off the point that Frank made, that energy independence is such a massive positive for the economy, and people forget that what happened in Europe after Russia invaded Ukraine was just a massive surge in inflation, principally driven through commodity prices and higher energy costs. And yes, okay, some of that did happen here in the States, and clearly there was a lot for people to cope with, seeing energy prices, whether it be power bills or even gas prices at the pump rising, but nothing on the scale of what was witnessed in Europe. And again, that speaks to the strength of America's ability to produce oil, natural gas, other key commodities that it's very difficult for some of these other countries, particularly the European countries, to compete with. So that is an absolutely massive thing for not just for independence, but for energy security as well. And clearly puts the US economy at a major advantage versus a lot of other countries in the world. I mean, look at what's happening in China, to give one notable example, in terms of how they treat energy and how energy costs really manifest themselves in the economy. So I think that is a huge point that going for America will continue to be that way. And again, look at the corollary to that, where you don't have that energy independence, where you don't have energy security, as in the case of a lot of the European countries. That was a huge, huge problem, which will take many, many years to really unravel.
So I can see the comments already. A lot of gold bugs watch this channel, and we are going to get to gold in just a moment. Very exciting right now, trading at all-time highs. But a lot of gold bugs embrace the narrative that the US empire is crumbling. The BRICS nations are going to rise up. There's going to be a gold-backed currency, this sort of thing. So I'm wondering if we have any food we can throw to the bears. Is there anything about the American economy at the moment that you think looks negative and that caution should be exercised when perhaps investing in America because of certain factors? Is there anything out there that you see? And William, I'll start with you.
Well, I think it's depending on, again, everything's relative. And whether you say it's an absolute negative or it's just negative relative to where it's been. But, clearly in my view, one of the things that's been driving the gold price is the strength or the lack thereof of the dollar. And, when you look at an economy, which now, as of, late last week and beginning this morning, the odds of a rate cut in June, I think now are somewhere in the order of 74%, in favor of the first cut in June, that, all of that starts to weigh on the dollar. and a weaker dollar, all things being equal, is positive for gold. And I think that's one of the factors driving gold at this time. The national debt, rising at a rate of $1 trillion every 100 days or so, clearly is another factor that is driving interest in gold and driving, people perhaps out of the dollar and into assets like gold. So while everything has to be taken in context for obvious reasons, to me, the dollar reversing its trend of strength that has been on up until the last 12 months or so was a key point, with interest rates peaking and showing that, I think that from a debt perspective, people can look at the rising debt that's not going away. That is a problem that has to be resolved, but governments still seem to be, going the way of inflating their way out of this, which is positive for gold.
And Frank, any reasons you see to be bearish on the U.S. economy?
To be bearish is concern on consumer spending and the stress that's being felt. Many of my friends own restaurant chains, and they were telling me that more people are paying with cash than credit cards because they've tapped it out, but they still want to go out. And there's a great concern over lockdowns and COVID that people still want to go and spend. And I find it interesting because we have the JETS ETF. And to me, I look at the valuations, and they're 1/3 of trains and trucks. They're such low multiples, and you can't get a discount booking a year out from now. So the airlines are making a ton of money, and there's a lot of sort of pent-up demand that people still want to travel, and they have what's called pricing power. So I think there's some interesting parts of that people still want to travel. The airlines are, even with oil prices slightly rising here for them, it's not been a big impact. So I remain positive about it. A geopolitical event like we saw in with Yemen, these are the things that are going to spark a sell-off in the market or something of this nature in a very sensitive year. This is an election year that there are 70 countries going through this election cycle. Now, America's only 4% of the world's population, but 25% of the world's GDP. So it's also going through this big election cycle, and government policies are always a precursor to change. And it's simple: monetary fiscal policy to attract votes. So I think the monetary policies are saying rates to come down. And the big thing I share with you, Jess, is MMT, modern monetary theory, was embraced this century by the G20 countries. And that means throw more cash, and each cycle, every crisis is always 3 to 5 times more cash to turn the economy around. And governments believe they can just tax away that money to get back to a normal economy, but it's not happening. The money base continues to grow globally. And that's why gold, shocking when I tell the people, this century, gold has been up 82% of the time, positive. I mean, that's a pretty compelling number, and that helps support Ray Dalio being the biggest hedge fund in the world. That's always has a 10% winning in gold, and sometimes has gone up to 25% in this parity trading. So gold is an important asset class, and in North America, it's predominantly the fear trade. We're going to see real interest rates go negative again later this year, and that's very positive for gold. But betting against America and the dollar is bad, etc., I think is just false. I think really what you have to be betting against is MMT, and is practiced by the G20 finance ministers and central bankers. They meet often. They have their own meetings outside of leaders of the countries of the world. And I think that we've witnessed that the gold is up 50% more than the S&P. I mean, that's a real compelling this century when you take a look as a data point. What's been really dismal has been gold stocks. And I follow 87% of the producers. And one of the things I've noticed is I look at the free cash flow yield. This time last year, 65% of them had a positive free cash flow yield. And now it's down to under 50%, I think 42%. Is that inflation last year impacting them? I don't know, but I do know that the quant funds, who are 50% of all the trading on the market, they look for factors like free cash flow and free cash flow yield and the allocation of capital. And so the gold stocks, I think I looked at the number last year, gold was up 11%. and there was only 9 companies that grew their revenue on a per share basis greater than the price of gold went up. So I looked at another data point and comparing it, say, the crypto mining companies, and they use the operative word called HODL. That is, hold on for dear life to the volatility, not be afraid of it. What we see there is that many of the companies hold on to their Bitcoin, and such as Hive has over 2,000, almost 2,200 coins, and that's worth $120 million on the balance sheet. When I go back to 20 years ago, 25 years ago, I Am Gold put gold on their balance sheet, and they outperformed, had a higher price to book. Rob McEwen's Gold Corp, they put gold on their balance sheet. And so did another smaller West Dome that Donovan Pollitt built. They put gold on their balance sheet, and they had different valuations. I think these gold producers will have to come up with something, if they have free cash flow, to stop selling all their gold and just think about preserving capital if they believe gold's going to trade higher.
Well, I think that's a good segue to discussing where you're currently seeing value in the market. Frank, I'll start with you because I'd like to follow up with your comment on the gold producers currently being quite undervalued compared to the price of gold itself. Is that an area you're currently looking at that you see presenting opportunity at the moment? And is there anywhere else you think looks compelling right now?
Well, I do have a gold ETF that's quant driven, Smart Beta 2.0. And it's interesting because it was focused on the royalty model. And the royalty model is a superior model. When you take a look at, would you like to own the producer, say Newmont, its revenue per employee is about $400,000. Franco-Nevada has royalties on both Barrick and Newmont's assets in Nevada, and they enjoy $24 million of revenue per employee. So that is a superior model. So I think that the royalty model is something to focus on. And you can go down to some of the new companies that are being created and formed. They have that royalty model, that discipline. And I think that's where the focus should be.
Yes, I'm all about the royalties and streaming. I agree. Much lower risk and still very good return potential. William, where are you currently seeing value in the market? Maybe places you think investors should be paying more attention to?
I think the big theme for me is there's no doubt that certainly some of the mining companies and the areas of the market, whether you're talking about housing stocks or commercial real estate, that have naturally suffered on the back of higher interest rates. But I think the focus around the top tech companies has been so big that perhaps now is the time for a broadening out of the market. If you look at the Russell 2000, for example, it's underperformed massively compared to the S&P, compared to the NASDAQ. And so this year, although the Russell is still underperforming those other two benchmarks, perhaps we'll start to see a better year for the smaller companies as interest rates come down. So as Frank was saying before, I think when you think about the back half of this year, if we start to see the first cut in June, perhaps some other interest rate cuts, I think we could potentially see a broadening out of the rally and not just be talking about the 7 largest technology companies, but the broader market as well.
And what about if your goal is simply capital preservation, whether there are those who are worried about a steep correction potentially coming for the broad market, or whether one is in a position where they're in retirement, they've already accumulated wealth, and now they want to protect it? What is the best way to approach that right now? Would it be fixed income, treasuries, gold? What are your thoughts there, William?
Well, this is a really interesting sort of time because for the first time in many years, if you held short-term treasury bonds at the Fed, or indeed many CDs or just cash accounts, you're able to earn decent percentage return, 5% roughly. So for the first time, people are used to being actually paid an interest rate, for their capital, be it holding it in treasury bonds or in cash. Now, the interesting question is not so much the environment just now, but it's the environment later on this year and going forward, where if we start to see rates coming down, does your 5% end up at 3% at the end of the year, or does your 5% turn into 2%? And in that environment, again, does cash or do treasury bonds look as attractive as perhaps they do now? And so in that case, people also, as they have done in the past, have looked to gold for part of that mix, to preserve capital in these kinds of situations.
And Frank, your thoughts on preservation of capital in the current market environment?
I think the short-term bonds are as were to be, along with a minimum 10% weighting in gold. I do think gold trades this time next year, probably tests $3,000 with the rates coming off and the sort of the global economy going back to money printing to the degree that we saw on the last cycle. That's what my gut says, because PMIs, though something we follow is Purchasing Manufacturers Index. And the PMI, global PMI, is very important for commodity demand. And it's a forward-looking indicator. It forecasts about 6 months out. So if all of a sudden we get a turn in car demand, then you'll start seeing iron prices going up. You'll see copper prices going up. You'll see platinum prices going up. And what our data is showing, going back 20 years of data, when 1 month goes above 3 months, then all of a sudden you start getting a trend going on. And we're below 50. So we fell down to the low 30s. We went up to 60. And now we're below 50. And I think it's really important to follow that trend. The only way that's going to happen is from the go to MMT and have the other fiscal stimulus to get the global economy going. So I think that's going to happen. And I think with that part of that trade is going to be very good for platinum ETFs, gold ETFs, and I believe the smarter gold producers that really respect the cash flow return on invested capital model, those names, they'll outperform.
What's up, guys? Quick break. My name is Jay Martin. I'm the CEO of Cambridge House and the host of the Vancouver Resource Investment Conference. I wanted to quickly point your attention to a link right beneath this video where you can subscribe to our new weekly newsletter. If you want to better understand the minds of the best investors in the resource space, subscribe to this newsletter. I author it personally every Sunday, and I love writing it. Hit that link below to subscribe. All right, back to the interview.
Well, let's hone in on gold here. We've discussed it a little bit already, but quite exciting times for those in the trade, seeing gold at least at nominal all-time highs as we speak in US dollar terms. Gold has already been at nominal all-time highs in many other currencies up until this point. The Japanese yen comes to mind, several others as well. I'm wondering what both of you think gold's role is moving forward, whether you see it as a monetary metal, as something that may return in a form of trade in the monetary system. Obviously, we saw rumors before that the BRICS nations were going to have some sort of gold-backed currency for trade. Spoken to Alistair McLeod, he believes Russia is actually potentially moving towards a gold-backed currency within their own country as well. So I'm just wondering what your thoughts are on both the current price action of gold. Frank, you mentioned you think it could get to 3,000 next year. And also your thoughts on gold's role moving forward, if we could see it return to the monetary system in one form or another. And Frank, I'll start with you.
Well, I think it's predominantly the rogue nations which have illiquid currency, such as China. You can't use your credit cards in China. You have to convert everything to WePay. It's very, very different than it was before 2008. We've seen under the new leadership this sort of complete two-tier system. So you can't be a global currency, not like the British pound, not like the Japanese yen or the US dollar. They're much more in the euro, but you take a look at the differences. So to get credibility, China was told, this is about 7 years ago, by the Saudis, that they had to get more gold behind their currency to be of trade. So now they're taking renminbi for oil, but it's immediately converted to US dollars because their currency really is not fungible. And I think that a lot of people want to try to knock the US dollar. And I just really think the dynamic is too great for it to be derailed at this stage. But what other countries like Russia and China will continue to buy gold as support for their currencies to try to show relative attractiveness and value. But I think the other part is to recognize that Indian women wears 6 times the amount of gold that's in Fort Knox. So the love trade is 60% of all gold demand. And if you looked at last year, how rates soared above the real interest rates, gold should have been down to 1,400. It didn't, because of this great GDP per capita rising in Southeast Asia, India, Middle East, and China. So there's a certain inflection point that love trade comes in and just absorbs. This is the year of the dragon. If you're in Hong Kong, you're going to see big golden dragons in all the jewelry stores. So there's a different cultural affinity. For us over here, it's the fear trade. And that fear trade is negative real interest rates and an expansion of the monetary base and money printing. And I think that bodes well for that world of gold. But interesting enough, what Will was talking about earlier is that 3 years ago, the SEC came up with a rule for small cap stocks and micro cap stocks that really has hurt the industry, saying that they call them basically illiquidity basket. And what do I see in the mutual fund world is that it's 15% of the fund cannot be anything that's illiquid. Well, illiquidity has to do with the spread. So if you have a small price stock, the spread is always wider. So there's a push to go into big gold stocks like Druckenmiller sold to go and buy VRIC and Newmont, because just buy big liquidity names, even though on a relative basis, they're way overvalued relative to a lot of the small cap, mid cap, junior gold producers. So I do think that there's something there with the regulatory world has had an impact of unexpected consequences for micro cap, small cap, that will provide the great opportunities for investors going into that space.
And William, your thoughts on the future of gold?
Yeah, I mean, to echo what Frank was saying, I mean, I think one of the big trends has been central bank buying or mass accumulation of gold by central banks outside of the US or the European, monetary system. And, one of the obvious reasons for doing that is that a lot of these countries are accumulating large foreign exchange reserves. And most of the time, those are in currencies such as the US dollar, and they're looking to assets like gold to diversify the exposure to the dollar, just like any normal investor is, looking to diversify their exposure. And there's no doubt that will continue. There is a reason why this is now multi-year trend. And, that these countries will continue to accumulate gold and will continue to diversify foreign exchange reserves and have gold as part of the asset mix, as do European countries and the US. So that will continue. That's a positive trend for gold, along with these other factors.
And I would like to talk about silver as well as any other precious metals. Obviously, William, you have a platinum ETF, and last time I had you on the channel, we spoke in depth about platinum. So I'd love to get your updated thoughts on that metal, as well as any thoughts on silver you might have. And I'll start with you.
Yeah, so I think silver's been, from my perspective, it's been really disappointing. In a market where gold touched an all-time high again, and normally, I think all things being equal, we'd expect to see silver prices higher than the sort of the $23, $24 an ounce that we trade at today. And it's also a bit surprising to me, given that I think silver has so much potential, both in terms of particularly the electric transformation or the electrification of everything, with silver's use in photovoltaics, and solar, etc. So it is a bit surprising that we're talking about a silver price which is 50%, roughly below its all-time high, in a market where gold's just hit an all-time high. But I think perhaps, that is therefore the obvious answer to one of your questions around, where does some value lie in the market? And so all things being equal, gold prices appreciating, we should see something from the silver market as well. And I believe as well, with the fundamentals as they are, there's not a good reason for why silver prices are where they are. Platinum, palladium is a different story. And unfortunately, those markets continue to be challenged. Although, to Frank's point, I do think that, market like platinum, the picture does get a lot better, continued that, the market is in deficit and is projected to stay in deficit for some time. And with the Chinese economy hopefully showing signs of life, and if they can start to recover and that demand can increase, plus obviously the demand for platinum comes from the auto market, and some of that can stabilize to more sort of predictable buying patterns, then the platinum price can certainly increase from here. Palladium, I think, is still longer term challenged. I think that's a market that's going into surplus in the next couple of years, but fundamentally is much more challenged than the other two metals, platinum and silver.
And Frank, silver, one of the maybe most hated commodities at present. Whenever I discuss it, I get a lot of vitriol in the comments of people saying it's useless. They've been stacking it for 10 years. It's done nothing. Spoke with Rick Rule. He says he's almost never seen it as hated as it is today. And that actually makes it more appealing for him. I wonder what your thoughts are currently on silver. And if you have any thoughts about any of the other metals, definitely feel free to mention that as well.
Hi ho, silver. There's no doubt it's challenged, but I'm always fascinated when physical silver trades at such a big premium to the futures market, and so it begs, like, who's selling all this silver? Or is it desperate country production coming out of Mexico and Peru? Is that Bolivia? Is that where the suppression is taking place? I don't know, but I know that I bought 20 silver coins 20, 30, 40 silver coins last week. And I give them out. I give them out to all my employees every year. And years ago, I bought several thousand silver coins. And so I think they're just the best gift, because people don't immediately flip them and it's tangible in their hand. And so a lot of these people that are gripers says you just continue to keep buying, because eventually when it snaps, you just want to have a chance to be a buyer. And I think with the solar panels, the whole push, the green energy push, is not going to go away. It will have twists and turns to it, but it's not going away. But coming back as the PMI, that's the big number for people to follow. When that turns, we're going to see copper prices soar. I think copper is deeply undervalued if you really believe in the big green transformation. Silver is a big part of that transformation. So I remain, you buy. You got to be like the Bitcoin ecosystem. And a classic was, I go to a Spurs game and I have HODL gold. I have another one that says go gold. And no one ever says anything to me when I have gold walking up from my seats at the Spurs game. And when the other day I had HODL gold, and young kids are giving me high five. They never saw the word gold. They saw HODL. And I think that psychology has to permeate and go into the gold ecosystem, that they have to take and understand what's going on, and the scarcity. I would say the Bitcoin ecosystem has done a much better job of telling the narrative on the scarcity, and not be afraid of buying the dip, and don't complain, stock coins. And that mindset is going to really think the leadership's going to have to come from the gold CEOs and these boards of, if they have this free cash flow, rather than doing a dumb acquisition, they ought to turn around and start hodling their gold or their silver production on their balance sheet. And that millennial investor is different than the baby boomers my age. They will go to that company, and we have seen that in the Bitcoin mining fraternity.
Well, let's now move on to any other metals, commodities, or assets that you think could hold value at the moment. Frank, you mentioned Bitcoin. Some people consider that a commodity. I personally do. I'm wondering where you see the future of Bitcoin at the moment, because here we are hovering near all-time highs in Bitcoin as well as gold at the same time. So very exciting if you're a holder of both, which I personally am. So I wonder what your thoughts are on Bitcoin, and if there's any other parts of the commodities market you're looking at. Uranium, obviously an interesting story. What are your thoughts?
Well, the differences and the similarities. Both Bitcoin groupies, or maximists, like to call themselves, and gold bug, both read from the Old Testament of economics. And so what are the similarities? Well, both are decentralized assets. Both are portable assets. One is much more portable. That is, Bitcoin is much more portable than gold, but gold is much more beautiful. to wear. And that's why many countries have used gold both for jewelry at the same time for the family's wealth, is because it's portable. I think that the difference would be that Bitcoin is capped at 21 million coins. I saw this when happened with gold when the GLD came out in 2004-5. Gold went up fivefold from that level. And the adoption, that adoption process as gold as an asset class all of a sudden grew. The regulatory and anti-banking, the banks that are anti-gold at the time of all of a sudden accepted as a GLD. And I think that's what's going to happen with Bitcoin. But the difference is there's 21 million coins. And the other thing is demographics. Millennials are used to digital money from gaming. They get rewarded if you're very good at gaming with these digital money that lets you upgrade into the software. So that idea, I grew up with monopoly money. I grew up with having a paper route. I can't discuss a paper route with my children. It's not going to happen. They can't relate to it. Even the game Monopoly, trying to teach it. So I think it's this idea of the shift of wealth from my demographics to your demographics. It's easier to accept digital money. And I think the fact is that there's over 17,000 active nodes validating 24/7 the Bitcoin ecosystem. There's 195 countries. There's 150 central banks, but we're talking about over 17,000. So I think that that's really, there's many more of nodes out there validating 24/7 than there are gold analysts. So you must recognize that there's something big is happening. So even though Bankman tried to fry the whole industry, as they like to say, it still has this resiliency to come back in the adoption. And both are for MMT, but Bitcoin is for the aggressive growth investor and gold is for the conservative investor. Both should be in your portfolio and depends on your temperament of volatility. The volatility of Bitcoin is 4 times that of gold. And I think you must recognize that difference before you go ahead and diversify with it. But I think these decentralized, what they call alternative asset classes, are very important in a portfolio.
Yeah, well, you're preaching to the choir when it comes to me. Probably not so much our audience. Most of the hardcore gold bugs and commodities investors do not love Bitcoin, but slowly but surely we'll turn them around. William, your thoughts on any other commodities or asset classes you're currently seeing value in? I'd like to get your thoughts on uranium if you're following that story.
I think that maybe we'll start with oil. And, again,
Nice.
the price of oil has ticked up quite nicely, over the last few months. And, with oil going back up to the $80 a barrel range, I think, again, it's moving kind of in concert with, the rest of the market, that people are generally feeling better about the economy. And with that, the pro-cyclical assets, things like oil. Just a word on what Frank was saying about copper, because that is, I think, an area of the market that has caught people by surprise. And, not just copper, with some of the other metals that are, going to be so important or are so important already for the energy transition story, the lithiums, the cobalts, etc. And with these metals really not performing, I think it's caught a lot of people by surprise in terms of perhaps the timing of the move, in terms of these particular metals. But that's definitely an area of the market that I think is a lot more depressed than if you'd asked anybody, 12 months ago, would have been probably a very different story. So I think, broadly speaking, the commodity market's reflecting, the economy right now, and that we've gone from a very negative place where we were in terms of commodities, certainly probably the end of 2022 and for much of last year, things have started to turn around. And, I think the Chinese story, while still is the big black mark on commodity demand, hopefully that we start to see some signs of life and, again, signs that the Chinese economy is starting to move away from, this, place it's been in over the last 12 months, which has clearly affected demand at a macro level quite significantly.
Well, I would now like to just open the floor to each of you to discuss anything you think it's important to talk about that we haven't covered, something you think investors should maybe be paying attention to, or just really anything that's on your mind. And William, I'll start with you.
I think we've talked about, a lot of the key stories going on in the commodity world. I'm not sure that there's necessarily anything else to add unless there's a smart question, addressing something specific. But I think the energy transition story is perhaps the area that surprised me most in terms of a lot of the commodities around that, particularly the metals, haven't performed as of yet. And gold at all-time highs again. Who would have thought necessarily that these cycles seem to take a lot longer many years ago, but now seem to be compressing, and we're talking about a new high in gold every few years as opposed to once every decade or so. So those are kind of two interesting observations, if anything else.
And Frank, the floor is yours. Anything that's on your mind you think investors should be paying attention to?
I think when we see the rates start to drop and PMIs turn positive, the trend, each month that is above the previous 3 months, the correlation to commodity prices runs up to 85%. So we're still in the sort of sideways up and down, no serious trend to take place. But when that happens, the trend is your friend. The other part is when I look at the Bitcoin and what Hive is doing, we're so focused now on our AI business, and it really is booming. We were the biggest Ethereum miners in the world, first crypto mining company to go public, but the Ethereum mining was extremely profitable. And that went away from proof of work to proof of stake. And all our NVIDIA chips, we've been moving over for the AI, and the fact that so much money is going in Silicon Valley towards the coders and new ideas, etc. The demand is incredible. So we've seen our revenue go from $250,000 free cash flow last year for the first quarter. Now it's pushing $250,000 a month, more than almost every 2 weeks now. So I see that trend anywhere in that AI business. The data center business will remain strong for the great digital transformation. But when it comes to commodities, what I learned is creating a mutual fund for luxury goods, because I learned from the world of gold and the love trade that there's something else happening with Ferrari. So if you want to go buy a Ferrari and you try to flip it, well, you'll never get a new Ferrari. You'll have to always buy second in the secondary market. And the same thing with Hermes. If you get on the president's list and you can buy one of those bags that cost $6,000 for this purse, on the street it's worth $18,000. So the idea and the concept of limiting supply and increasing adoption and demand, and the rise of GDP per capita for the middle class in so many countries, they all want the luxury goods. And you're seeing the LVMHs, the Hermes, the Ferraris, limits even the watches, because the Apple Watch had a big impact on high-end watches. All they did was cut back the supply, and the prices went up. And they maintain that pricing power. So I think that luxury goods have done exceptionally well. And I see they call the dinks, double income, no kids. Well, they all want to wear luxury goods. China's opened up, and travel in Europe is now picking up. Well, once again, luxury goods being consumed in Europe is inching up. So I like that sort of industry, which I think has better legs to it. And we look at Costco versus Walmart. Well, Costco, they sold $100 million worth of gold. And it's interesting on the demographics that they were predominantly professional Chinese and Indian women working in America. They're the ones that went out that have the cultural affinity, and they say, oh, it's easy to buy those an ounce of gold. They bought it. So I think that Costco is a luxury goods company relative, say, to a Walmart, and it's looking at in your portfolio where you're shopping. If we can take a look, even Ross Dress for Less, that stock's been on a tear for the past 3 years because they moved luxury goods.
Very fascinating thoughts. We've covered a lot today, gentlemen. It has been an extremely enlightening conversation. I know I've learned a ton. Before I do let both of you go, William, tell us about Granite Shares, what it is you do there, and where people can find it.
Yeah, thanks, Jesse. So Granite Shares is an ETF issuer, which means that we create ETFs, manage ETFs, and market ETFs. So based in New York City, but the business is global, and since that we have ETF strategies here in the United States and in major European markets. And we really do different types of strategies, but what we like to say is we focus on the high conviction investor, whether that's someone who's looking to invest in gold or commodities, to the opposite end of our spectrum, which is leverage on single stocks like 2x NVIDIA, long and shorts, or Tesla, etc. So we offer a range of strategies for investors, but we kind of think of it as the general theme being high conviction products for high conviction investors.
Well, I will put a link in the description below to Granite Shares for people who want to check out your ETFs. And Frank, tell us about Hive Digital Media as well as US Global Investors.
I will, but I got a question to ask Will. Will, you have triple X's, don't you? Like 3x leverage?
Yes.
And is that on an individual name like Tesla or
Yes.
NVIDIA?
Yes.
And are you also doing where they do the covered writing rolling over every 20 days to capture that vol?
We're not doing that. That's something that I think is pretty interesting, and people are, creating some crazy yields in terms of those strategies, which seem to have permeated, almost every, sector of the ETF world. So we don't currently offer those, but it's certainly something that's interesting.
And what are the hottest triple X's you have?
The biggest one, probably no surprise to anybody, is NVIDIA. That's the largest single stock ETF in the world now. So that's NVDL, and that's 2x leverage on NVIDIA. And just, again, that the whole AI trend and that being the poster
Talk about
child
steroids.
AI. Yeah.
Wow. Wow. I love it. I love it. I love NVIDIA. They're having a big week next week for all their new services and products and where they're being applied. And Hive has, I think we have 5 people going to it. So it's very exciting. Those GPU chips. At one time, we used to, when mining Ethereum, we had 130,000 AMD GPU chips. So that taught us a lot about GPU chips, because it's like driving a Porsche versus ASIC Bitcoin mining is like a Ford 150 pickup truck. And then we started buying NVIDIA, and we have about 36,000 NVIDIA chips that allow us now to hook them up to super micro servers. And we put 10 of the NVIDIA chips into the micro server, and then we rent it out, and we make 5 to 10 times more per hour than we do ASIC mining, even with Bitcoin where it is, which is really an interesting dynamic. But I've had to learn and keep my brain young about this whole growth of what's going on in the world of AI. And it is very exciting. And that's what Hive is.
Incredible story.
Pardon me?
As I said, it's just an incredible story, the transformation, the whole space over the last, 12 months or so.
It's stunning. And I've been to Silicon Valley about four times now, and it's just incredible activity, amount of money that's going into AI. But what coming back is that what Hive was the first crypto mining company. We mine in Sweden, we're in Iceland, we're in Quebec, and we're also in New Brunswick. We have about 130 megawatts around the world. It's only green energy. We're the first to recycle our energy from one building to another. When the second building is 5 times greater. So we get this from hydroelectricity. We are able to keep recycling that molecule of heat. And we're the first to do our own chip with Intel. And so we're like a technology company, but we're very lean, like a royalty company. We're doing about 8 million in revenue per employee, which is much higher than the median. And our AI business is going to become a huge channel of growth for us, in addition to being approximately 1% of the global Bitcoin network, mining network. And that's really helped my brain to take a look at other activities. I tried to launch a Bitcoin ETF in 2017, and I realized it wasn't going to happen. And it just happened this quarter. But I did launch the first crypto mining company as my key investment in that space. US Global Investors is usfunds.com. I write to my team, helps me with the research department, do a SWOT analysis of gold to luxury goods to other parts of the economy. And we produce content that's read in 80 countries by 100,000 readers. So it's usfunds.com, the investor alert, and Hive Digital is easy to get on our website. And we have lots of educational content on AI in the crypto space.
Great. Well, I'll put links to both of those as well below in the description. Gentlemen, it's been an honor and a great time chatting with both of you.
Thanks, Jesse. Much appreciated. Great to see you.